the invention of money. For thousands of years, humans traded directly. You had grain, your neighbor had cloth, and you swapped. But bartering only worked if both people wanted what the other had. If you needed salt but only had chickens, and the salt seller wanted tools, you were stuck. Trade was slow, clunky, and limited. Communities stayed small because growth required trust, and trust didn't scale. Then, someone had an idea. Instead of trading things, what if we agreed on symbols that represented value? Shells, beads, and eventually metal coins became the stand-in. A coin wasn't valuable because of what it was made of at first. It was valuable because everyone agreed it was. Suddenly, you could trade anything with anyone. The farmer could sell wheat to the blacksmith, take coins, and buy pottery from someone else entirely. Exchange became fluid. Markets exploded. Cities grew. Civilizations expanded because people could specialize, knowing they could always trade their work for what they needed. But money created something else too. It made wealth portable, storable, and unequal. Those who accumulated coins gained power. Those without them became dependent. Value stopped being about what you made and started being about what you owned. Money didn't invent trade. It invented the idea that some people could have everything while others had nothing. It gave civilization a common language, but that language spoke loudest for those who had the most to say.
The first banks. Once people had money, they faced a new problem. Where do you keep it? Hiding coins at home meant thieves could steal everything you owned. Carrying wealth while traveling made you a target. There was no safe way to store value or move it across distances. Trade was growing, but trust was fragile. Temples and goldsmiths became the solution. They already had strong walls and guards to protect sacred objects and precious metals. People started leaving their coins with them for safekeeping. In return, they received a receipt, a piece of paper proving how much they'd deposited. Over time, something strange happened. Instead of withdrawing coins to buy things, people just traded the receipts. The paper itself became money because everyone trusted it represented real gold sitting in the vault. Then came the revelation. Goldsmiths noticed most people never withdrew their deposits. The gold just sat there. So they started lending it out to others and charging interest. They created more receipts than they had gold, betting that not everyone would ask for their money at once. Suddenly, money could multiply. A single gold coin deposited could become 10 paper receipts circulating in the economy. Banks didn't just store wealth. They discovered that money could work, grow, and reproduce while sitting still. But this also meant the system ran on belief. As long as everyone trusted the receipts, prosperity flowed. The moment that trust broke, everything collapsed.
The rise of taxation. Empires needed resources. Armies required food, weapons, and wages. Roads had to be built, aqueducts constructed, and walls fortified. Kings couldn't fund everything through conquest alone. They needed a steady flow of wealth from the people they ruled. But asking for donations wouldn't work. Power required certainty. So rulers created a mandatory system. Every citizen had to give a portion of their harvest, income, or labor to the state. This was taxation, enforced by law and backed by punishment. Farmers surrendered grain. Merchants paid in coin. Laborers worked on public projects without pay. Refusing meant fines, imprisonment, or worse. The deal was simple. Give us a share of what you earn and we'll protect you, build infrastructure, and maintain order. Taxation transformed societies. It funded roads that connected distant cities, armies that defended borders, and temples that unified culture. Empires expanded because they could organize resources on a massive scale. Public works employed thousands. Governments became permanent institutions instead of temporary warlords. But taxation also created a permanent tension. Citizens resented surrendering what they worked for. The wealthy found ways to hide their fortunes. The poor bore the heaviest burden. Revolts erupted when taxes climbed too high. Entire economies bent around avoiding or collecting payments. Taxation built civilization by pooling individual effort into collective power. But it also taught people their first financial survival skill, finding ways to keep what they earned hidden from those who demanded a share.
The banking system. Early banks operated alone. Each one held deposits, made loans, and kept its own reserves. If a merchant in London wanted to pay a supplier in Paris, moving physical gold was slow, dangerous, and expensive. Banks existed, but they couldn't talk to each other. Money stayed trapped within individual institutions, limiting how far commerce could reach. Then, banks started connecting. They formed networks, agreeing to honor each other's notes and transfers. A deposit in one city could fund a purchase in another through letters of credit. Trade accelerated because money could finally move at the speed of trust instead of the speed of cargo ships. But the real transformation came from a radical idea: fractional reserve lending. Banks realized they didn't need to keep all deposits in the vault. If 100 people deposited one gold coin each, the bank could lend out 90 of those coins and still cover daily withdrawals. Those 90 coins would be spent, then redeposited in other banks, which would lend out most of them again. 100 original coins became thousands in circulating currency. Economic growth exploded. Businesses could borrow to expand. Farmers farmers could buy equipment before harvest. Entire industries launched on credit. Wealth multiplied faster than ever before. But this system had a fatal flaw. It only worked if everyone stayed calm. The moment people panicked and rushed to withdraw their money simultaneously, banks collapsed. There was never enough gold to cover every claim. The banking system created prosperity by lending the same money over and over, gambling that no one would ask for it all at once.
The Industrial Revolution.
For centuries, making things took time and human hands. A blacksmith forged one tool at a time. A weaver made cloth thread by thread. Production was local, slow, and limited by how many hours a person could work. Economies ran on muscle power, animal strength, and small workshops. Wealth grew incrementally because output couldn't scale beyond human capacity.
Then machines changed everything.
Steam engines powered factories that could produce in one day what a craftsman made in a year. Textile mills churned out fabric by the mile. Iron foundries cast metal in massive quantities. Production exploded because machines didn't tire, didn't sleep, and multiplied output exponentially. Workers flooded from farms into cities, trading fields for factory floors. They earned wages instead of growing food, becoming dependent on money for survival. Capital became king. Those who owned factories accumulated wealth faster than anyone in history. Railroads connected markets. Steamships crossed oceans. Goods that once took months to produce became cheap and abundant. But this prosperity came with a cost. Factory workers labored 14 hours daily in dangerous conditions for minimal pay. Children worked alongside adults. Slums swallowed cities as populations surged faster than housing. Wealth concentrated in the hands of industrialists while workers barely survived. The Industrial Revolution proved machines could create almost infinite abundance, but it also revealed that efficiency and humanity don't naturally align. Production became cheap, living became affordable, yet somehow the human cost remained expensive. Machines made everything except dignity more accessible. The gold standard begins. By the 1800s, every country printed its own currency, and none of them agreed on value. A British pound meant something different than a French franc or an American dollar. Exchange rates fluctuated wildly. Governments could print money whenever they needed it, causing inflation to spike unpredictably. International trade was chaos because no one trusted anyone else's paper. Then, Britain made a promise. Every pound they issued would be backed by a specific amount of gold sitting in their vaults. You could walk into a bank and exchange paper for actual metal at a fixed rate. Other nations followed. Suddenly, currencies had anchors. A dollar, a franc, a mark, they all represented a defined quantity of gold. This changed global commerce. Exchange rates stabilized because every currency connected to the same universal commodity. Traders knew exactly what they were getting. Investment flowed across borders because value was guaranteed by something physical. Economies synchronized. International business boomed because trust was finally built into the system itself. But the gold standard created a trap. Governments couldn't print money to fight recessions or fund emergencies without gold reserves to back it. Economic flexibility vanished. During crises, countries couldn't inject cash into their economies without mining more gold or buying it from others. Growth became limited by what could be pulled from the ground. The gold standard made money trustworthy by chaining it to metal. But that chain also locked economies into rigidity, unable to adapt when the world demanded change faster than gold could be found. The Federal Reserve is created. America's banking system in the early 1900s was fragile. Every few years, panic would strike. Rumors would spread about a bank failing, and crowds would rush to withdraw their savings. Banks couldn't cover everyone at once, so they collapsed. When one fell, fear spread to others. Entire chains of banks would crumble within days, wiping out fortunes and destroying businesses. There was no safety net, no lender of last resort, no institution powerful enough to stop the cascade. After a particularly devastating panic in 1907, the government decided something had to change. In 1913, they created the Federal Reserve, a central bank that would oversee the entire financial system. The Fed could lend money to struggling banks during crises, preventing panic-driven collapses. It controlled interest rates, deciding how expensive borrowing money would be. It regulated how much currency flowed through the economy, expanding or contracting the money supply based on economic conditions. Banking stabilized. Panics became rarer. The economy had a guardian that could step in during emergencies and keep the system from imploding. But this concentration of power came with consequences. The Fed could now influence booms and busts, deciding which industries thrived and which struggled. A handful of unelected officials controlled the financial fate of millions. Their decisions shaped employment, savings, and economic growth across the entire nation. The Federal Reserve was built to prevent disasters by centralizing control. But centralized control meant that when mistakes happened, everyone paid the price together. The Great Depression. The 1920s felt like endless prosperity. Stock prices climbed month after month. Everyone wanted in. Factory workers bought shares on credit. Banks loaned money freely. People borrowed to invest, confident they'd make enough profit to repay everything and still get rich. The market seemed invincible, as if wealth could only go up forever. Then, in October 1929, cracks appeared. Prices started falling. Investors panicked and rushed to sell. The selling triggered more selling. Within days, the stock market collapsed completely. Fortunes evaporated. People who thought they were millionaires discovered their wealth was just numbers on paper. Banks had loaned heavily to investors and businesses. When borrowers couldn't repay, banks failed. People rushed to withdraw their savings before their bank collapsed too, which guaranteed it would. Thousands of banks disappeared, taking life savings with them. Businesses closed because they couldn't get loans. Factories shut down. Unemployment exploded to 25%. Families lost homes. Bread lines stretched for blocks. The economic machine that seemed unstoppable ground to a halt. The Depression lasted over a decade, spreading globally. Entire countries fell into poverty. Governments struggled to respond because no one understood how to restart a broken economy. The crash revealed a brutal truth. The prosperity of the 20s was built on borrowed money and inflated confidence. When belief shattered, the wealth underneath vanished because much of it had never actually existed. The Depression didn't destroy value, it exposed how much of it was always just collective imagination. The dot-com bubble. The internet arrived in the 1990s, and it looked like magic. Suddenly, information moved instantly across the planet. Businesses could reach millions of customers without physical stores. Investors saw endless possibility. Any company with a website and a dot-com in its name attracted millions in funding, even if it had never made a single dollar in profit. Money flooded into tech startups. Companies spent fortunes on advertising and expansion, burning through cash to grow as fast as possible. Stock prices soared. A business selling pet food online was valued in the hundreds of millions. Another that delivered groceries was worth billions. None of it mattered that these companies lost money on every sale. Investors believed profits would come eventually, once they dominated the market. The frenzy peaked around 2000. Then, reality arrived. Investors started asking uncomfortable questions. When will these companies actually make money? How will they ever become profitable? The answers were often, we don't know. Panic replaced euphoria. Stock prices plummeted. Companies that were worth billions became worthless overnight. Thousands of startups collapsed. Trillions of dollars evaporated from the market. But something survived. The internet itself kept growing. The infrastructure built during the bubble, the fiber optic cables, the data centers, the technology remained. Companies like Amazon and Google emerged from the wreckage and became giants. The dot-com bubble proved that revolutions are real, but hype inflates faster than value. The internet changed everything, but first it had to survive investors who confused possibility with guaranteed profit. The 2008 global financial crisis. Housing prices climbed steadily through the early 2000s. Banks started giving mortgages to anyone who asked, even people with no income or terrible credit. These were called subprime loans, risky bets that borrowers could never realistically repay. But banks didn't care about risk anymore because they found a trick. They bundled thousands of these mortgages together, sliced them into complex financial products, and sold them to investors worldwide. The risk got passed along, hidden inside instruments so complicated that even experts couldn't understand them. Everyone believed housing prices would keep rising forever. Homeowners borrowed against inflated values. Banks leveraged these assets 30 times over. The entire global financial system built itself on the assumption that American houses would never lose value. Then, in 2007, people started defaulting. Housing prices dropped. The complex financial products backed by these mortgages became worthless. Banks that owned them faced catastrophic losses. Lehman Brothers, a giant investment bank, collapsed. Panic spread globally. Banks stopped lending to each other, unsure who was hiding toxic assets. Credit froze. Businesses couldn't get loans. The stock market crashed. Millions lost jobs, homes, and savings. Governments spent trillions bailing out banks to prevent total economic collapse. Taxpayers funded the rescue while bankers kept their bonuses. 2008 revealed that the financial system had become a casino where banks gambled with borrowed money. When they won, they kept profits. When they lost, everyone else covered the bill. The crisis proved risk never disappears. It just gets redistributed to those with less power. Creation of Bitcoin. After 2008, trust in banks and governments shattered. They had caused a global crisis, then rescued themselves with taxpayer money while millions suffered. People started asking, do we really need these institutions controlling our money? In 2009, someone using the name Satoshi Nakamoto published a solution. Bitcoin, a digital currency with no central authority. No banks, no government, no single point of control. Instead, it ran on blockchain technology, a public ledger maintained by thousands of computers worldwide. worldwide. Every transaction was recorded permanently, verified by the network itself rather than a trusted institution. Bitcoin offered an alternative. You could send money anywhere, instantly, without banks taking fees or governments tracking transfers. Supply was limited to 21 million coins, programmed into the code, meaning no one could print more and cause inflation. Control belonged to whoever held the private keys, the digital passwords that proved ownership. Early adopters saw it as revolutionary, a currency that couldn't be manipulated, censored, or controlled by the powerful. The beginning of financial independence. But Bitcoin became something else. Instead of replacing money, it became an investment. People bought it hoping prices would rise, not to use it for transactions. Speculation dominated. Prices swung wildly, climbing to tens of thousands per coin, then crashing repeatedly. Bitcoin asked whether we still needed banks to control currency, but it transformed into another asset to gamble on, proving that even revolutionary technology can't escape human nature's desire to get rich quick. COVID-19 economic impact. In early 2020, a virus spread globally, forcing governments to make an impossible choice: let people die or shut down the economy. They chose lockdowns. Offices closed, restaurants emptied, factories stopped, airlines grounded fleets. Millions lost jobs overnight as entire industries vanished. Economies faced collapse. Governments responded with the largest financial intervention in history. They printed trillions of dollars in stimulus payments, unemployment benefits, and business loans. Central banks bought assets to keep markets stable. Money flooded the system faster than ever before. The goal was simple: keep people fed and businesses alive until the virus passed. It worked temporarily. Markets rebounded. Unemployment eventually dropped. Businesses survived. But the money didn't disappear. It circulated through the economy, chasing limited goods. Supply chains collapsed because factories had shut down, ships sat idle, and workers stayed home. Suddenly, there was more money competing for fewer products. Inflation surged. Prices for food, housing, and gas climbed rapidly. The money printed to save the economy now made everything more expensive. Savings lost value. Wages couldn't keep up. The wealth gap widened as asset owners benefited from stimulus while workers struggled with rising costs. COVID also accelerated changes already brewing. Remote work became permanent. Digital commerce exploded. Cash usage plummeted. The pandemic proved governments could create money instantly to prevent disaster. But it also taught a harsh lesson. Printing currency doesn't create value, it just redistributes it. The economy was saved by borrowing from the future, and the bill arrived as inflation nobody could escape.